Good morning, ladies and gentlemen. It is exactly 5 minutes after 10 here in Accra, Ghana, and so we would like to get started with this morning's event. Once again, you are warmly welcome to the 2025 edition of the Mid-Year Economic and Market Outlook webinar hosted by Axis Wealth. And thank you again for joining us for this important event. This is the third edition of the webinar, and we are excited to host you in what should be an insightful discussion. My name is Albert Boatin, and I'll be the moderator for this webinar. The purpose of this event is to provide you with forecasts on trends that will shape the second half of the year and give you, as well as provide insights that will help you make informed decisions going forward. And to do this, I am joined by seasoned investment experts from the wealth management team in the persons of Peter Bewa, Gideon Amweninche, and last but not the least, Eric Corti. And each speaker has been allotted a specific time to present in, and they'll be doing this in an agreed order, after which the remaining time would be given or will be dedicated to answering your questions that come up during the webinar. And again, should you have any question that comes up during the session, we encourage you to kindly submit your questions using the chat tab or the chat box, and the questions will be addressed during the Q&A segment of the webinar. And so, without wasting any more time, I'll hand over the microphone, or the virtual microphone, to Eric Corte to share some details of Axis Wealth's operations. And so, Eric, if you can hear me, kindly unmute and turn on your camera so our participants can see you. Eric, can you hear me?
I can hear loud and clear. Thank you very
Wonderful.
much, Albert, for the beautiful introduction. And thank you very much, our cherished participants, for taking time off your busy schedules and joining this all-important webinar. We don't take your participation for granted. It's always a pleasure to have you on our platforms. So without taking much time, let me just delve into what Axis Wealth Management is all about. And then I'll give you 6 reasons why you should work with us. Then I'll hand over the virtual mic, as Albert will say, to Gideon later. Next slide. So Axis Wealth is a wealth management and financial advisory firm, and we leverage on technology to give our clients access to global markets. Indeed, we have portfolios that work in over 150 markets, translating to over 34 countries, spanning 27 currencies. We are a specialized unit within the Axis Pensions Group, or a subsidiary of the Axis Pensions Group, the same group that owns Axis Pension Trust, a leading corporate trustee firm in Ghana that manages in excess of 8 billion Ghana cedi in client assets. We at the Wealth Management Unit seek to serve clients with net assets of around $25,000 to help you out in financial planning, and then also give you opportunities in global markets. Now, I'm going to take the next few minutes allotted to me to give you 6 strong reasons why I believe you should work with us. So we are predominantly a financial planning business, and at the heartbeat of what we do is financial planning. We link our wealth execution strategies to the kind of financial plans we build for you, and it's one of the most important things we do with you. And this financial plans helps us to elicit financial goals that you aspire to, achieve. It's a 360-degree engagement that starts from your cash flow goals all the way to your education goals, and especially for those of you who want to send your kids overseas, and then also for those of you who want to do private education for your children and things like that. So that's one of the reasons why I strongly believe you should work with us. Now, the second reason why I believe you should work with us, and it's very important, that we are very independent. We do not have any commission arrangements with any of the big mutual funds out there in Asia or even the US or anything of that sort. We don't have any form of commission arrangement. So that makes us truly independent. So that independence allows us or prevents us from pushing down clients through mutual funds that will not inure to your benefit. We focus on the broader market. We are able to use all the available securities out there to serve you well, just because we are truly independent, to ensure that client portfolios generate optimal returns, to ensure that we meet these goals from clients. So it's a very important reason why I believe that you should work with us, and you can only get this with Access Wealth. The third reason why I believe you should work with us is our investment thesis and our investment approach. So we use the model portfolio approach. Just to break it down a bit for you. So just look at the model portfolio as a basket with carefully selected or carefully curated securities to manage the risk and return dichotomy issues with portfolios, to ensure that, hey, you get the optimal returns you're desiring, and then your risk is kept at bay. So for those of you who are pretty aggressive, you see that we'll put you on a very aggressive portfolio that traditionally will have stocks, ETFs, with underlying assets as stocks, etc. For those of you who are pretty conservative, we put you on a portfolio that's very conservative to align with your interests. For clients who come to us and realize that, hey, you have great portfolios, but we don't fit in any of them, we are very, very happy to sit with you. We have the capacity to design a portfolio to put you in for. And then for those of you who are also pretty sophisticated, who want something beyond those model portfolios, we are more than happy to sit with you. I know people have dreams of having FNAANG stocks. You want an Apple stock, you want Amazon. We will have the conversation with you, and we are able to deploy those assets out as well for you. Our next reason why you should work with us is our people. And for me, I think these are some of the finest brains you'll find on the market, and they have the fiduciary with you, the clients or prospective clients, and beyond their competence and their ethics. For me, what makes me excited about this team is the passion with which they work to ensure that you are full of smiles throughout your engagement with us. Now, the other reason why I believe you should work with us is investor protection, because when it comes to investment, you are thinking long term and you want to have your peace of mind. That's why you're investing. So you would need some minimal level of protection. And this is to assure you that your funds do not sit or are custodied with Access. For global assets, for those of you who will be onboarding onto our global assets platform, your funds are custodied outside in the US with the broker dealer. Now, what you need to know is that every investment that is bought is vested in your name, right? So not in the name, not co-vested with Access Wealth, is vested in your name. And what the broker dealer has also done, ensured that for every account is insured to the tune of $30.5 million. It's indeed a very credible broker dealer we use. They are listed on the NASDAQ stock exchange in New York. They have regulatory capital of over 15 billion US dollars, 10 billion above regulatory requirements. So this are amongst other reasons where these are among other things that gives you some level of comfort and protection. And it's a key reason why we believe that you should work with us, because there's peace of mind and there's adequate protection. The other reason I believe you should work with us. As when it comes to finance, transparency is key, and the fee, and we are very transparent with our fee, and we charge one of the lowest on the market. For a service like this, in Ghana or in Jersey or anywhere around the world, the average fee ranges from 3% to 5%. And with us, there are no hidden fees. You're able to redeem your contributions at any time. There are no front load or even back load charges. There are no fees upon redemption, etc., etc. We charge up to 1.5 on assets under advisory. And this is done to align our interest with that of the clients as well. So the relationship with us is a lifelong relationship, and we work with you all the way throughout major events in your life, helping you, achieve all these financial goals. We are just a call away. We ensure that we help you do your planning properly. We execute your strategies well. We review them from time to time, till it comes to a time where we all have to check out and meet our maker, and where we also help you beautifully transition through our estate planning services, transition this wealth that you've accumulated to the next generation. I believe that for those of you who are on this call who are not yet clients, and if you want to engage with us, we are very, very happy to do that after the call. We believe that we'll share some contacts, and we are happy to jump on calls, have physical meetings, to explore how we can work together, and we are very happy to have you on board. At this juncture, I just want to say thank you to all of you once again for joining this presentation, and I would want to hand over to Gideon to take us through the next set of slides. Thank you.
Okay, thank you very much, Eric, and a warm welcome to our cherished participants. We really appreciate making time for this webinar. So in this presentation, I'll quickly review what... Hello, Albert, I hope I'm audible.
Yeah, very audible, Gideon.
Okay, great. So on the next slide, it will show what I'll quickly review in this presentation. And in this presentation, I'll review some key macroeconomic indicators that have shaped our markets that we are invested in and keep influencing the direction in which our markets go. At a very top level, I think both Q1 and Q2 have been significantly impacted or shaped by the Trump tariff war against all nations across the globe. And if you look at the economic indicators, they have actually all been steered by this factor I just mentioned. On inflation at the top level, inflation is expected to slow down across the globe, and in most countries, monetary policy is expected to react to that. And so we are expecting most countries to ease or cut rates. But then currently, because of the inflationary risk, because of the tariff, most countries are slowing down on the cuts. On headline GDP, GDP growth has remained resilient, and we expect it to keep up to that pace, except that US is likely to experience something else, which it's just a forecast because of what the current situation is. But I believe they are going to make headway. And then in terms of markets, we expect, or markets have been positive, and we expect that to carry on through. With this background, I'll quickly move on to the inflationary trends we have experiencing. So global inflation is expected to slow down to 4.3%. And the main factor driving this is across the globe, we see weak demand for consumer goods and services. Again, most countries have experienced currency appreciation against the USD, which influences cheap exports. One other thing that has also influenced this trend we are expecting is that oil prices have been trending lower. And we all know that when oil prices go down, its effect on inflation is quite significant. It's unfortunate. It's the reverse we are seeing currently in the US. the latest print of inflation that came up showed that inflation picked up slightly to 2.7%. If you compare that to the March print, that was 2.4%. And the main thing that has caused this trend is the fact that there has been a pass-through on import costs to consumers. And so cost has actually gone up, and that's what is influencing this 2.7 print we saw in June. If you look at the euro area, you would actually also see a contradictory trend there. And inflation in the euro area rather trended downwards to 2% against the 2.2 that was recorded in March. And the main thing that has driven this trend is the fact that a lot of, the main thing that has actually caused this trend is the rapidly declining energy prices, which is filtering through consumer prices. And so inflation is trending downwards. With this inflation background, let's look at how monetary policy trends have been across the markets or the countries we are invested in. And on the next slide, if you look at monetary policy in the US, the Fed rate had been stable throughout the period. In June, it still remained at 4.5. The latest print will be released today. And the main thing is you can see that there is, that cautious approach because the Trump tariff regime war is expected to create some inflationary spikes. And so they have adopted the wait and see approach so that they don't quickly move ahead and reduce rates whilst inflation is picking up. So that's what has largely influenced the monetary policy decision the Fed has taken. If you move on to euro area, it has been a different story there. Inflation is coming down. They have kept cutting rates for some time, but the recent decision they took, they fed the monetary policy rate stable. And then that's also largely because they want to wait and see and ensure that inflation level that they are seeing now is stable over the medium term. If you move on to emerging markets area, largely the trend that is seen there has been that most central banks have been adopted an accommodative monetary policy stance, and they have actually been cutting rates. But there seems to be a recent concern about inflation going forward. And so this rate cuts that we saw is actually also slowing down in emerging markets. With this, we can move on to look at how growth has also been across the globe, particularly in the US, because we are heavily weighted in investments there. The latest prints for GDP growth that came out showed that the US economy contracted in the first quarter of 2025 by 0.3%. And what actually caused this is not the fact that the economy is slowing down, but it's all because of the tariff war. And so most businesses try to front load their imports. So imports, GDP is also affected by net imports or net exports. And so because a lot of businesses did import a lot, it did actually affect GDP growth. But if you look deep down in it, the economy still remains strong. Consumer and businesses largely also produced well. And so it's not really a negative story like that. If you move on to euro area, GDP growth actually came out stronger than expected. And it's the reverse of what happened in the US because most businesses rather exported or front-loaded their exports ahead of the tariff taking effect. And in emerging market area also, GDP growth has been quite resilient and strong. And so that's, how these are filtered through in GDP growth. We'll quickly move on to the markets and see how these economic indicators and events and trends have shaped the markets we are invested in. And so on the next slide, it talks about the equity market performance over the different quarters we see. So the last line shows the year-to-date performance of the various indices. Albert, I think you have to move again. So this shows the various indices we track, and also shows the equity market performance across the globe. In the last quarter, or in the second quarter, we saw that markets bounced back. Performance across most of the indices turned positive, and quite really a strong performance. However, in Q1, we ended most of the indices ended the quarter on a negative note. So if you look at the S&P 500, for example, just in the second quarter, performance or return was 10.94%. The Nasdaq retained 17.75%. The Russell retained 8.11%. If you look across the Euro area, which we use the S&P to track, that's retained 3.23%. Emerging market area was quite strong. And so markets have largely been positive. Year to date, the S&P has retained 6.2%, and you can see across board performance has actually been strong. We'll move on to the next slide, which talks about the fixed income performance. And on the fixed income market also, if you look at the various indices that we track, the US Ultra Shorts, which tracks mainly US Treasuries, in the second quarter retained 1.03%. If you look at the Treasury bonds, that retained 0.86%. Investment grade bonds retained 1.65%. And these, returns we are showing here are largely price returns, not coupon returns. So we are just looking at the price performance of these indices that we track. And so largely, both the equities market and the fixed income markets have recorded strong performance over the past 2 quarters we have stayed invested. I'll bring my presentation here to a close and hand over to Peter, who would give us much more of the outlook.
Thank you, Gideon and Eric. And thank you to all of our participants for taking time out of your busy schedules to join us this morning. Really appreciate your time. So I'm gonna go over where we are, mid-year review, as far as, first half of the year, and then also share our outlook for the rest of the year. Next slide, please. So as far as the markets go, in spite of all the volatility we've experienced this year, with all the uncertainties, economy continues to grow really strong, basically referring to the US economy, which is the largest in the world. And then when the US sneezes, the rest of the world catches a cold. And so it's important to kind of start with the US, economy, and then filter it down to other parts of the world. But the US economy continues to grow, although growth is slowing down. It's not growing as fast as it was the year before and the one before that as well. However, we still continue to see economic growth. Q1 numbers came in slightly low, Q1 GDP, but that was mostly due to the fact that imports exceeded exports, which Gideon alluded to earlier on. But the domestic, GDP, domestic production and consumption was still very, very strong and in a positive, trend. We also continue to see inflation continues to trade in a trend in a range. It's been range bound, and so we saw a little, pickup in inflation last month. That was mainly due to impacts of Trump's tariff policies. However, we're still within the 2.5, 2.7, range. It's not gone up above 3% over the last year. We think that overall inflation is in a good spot, and with the volatility continuing to come down, we're going to see inflation trend towards the Fed's target of 2% in the near term. But so far, inflation has been stable. We've seen unemployment so far this year has been also very stable. It stayed around the 4.2%, which is very close to full employment. Consumer spending has been strong. Consumers make up almost 70% of the US economy. And with stable job environment, stable employment, and stable inflation, consumers feel comfortable spending. The only change in the spending dynamics is that there's more consumption as far as staples and also necessities go, whereas they've cut back on discretionary spending. And so we've seen consumer discretionary has not done too well, but consumer staples have continued to do well because of consumer spending. That continues to be strong. We've also seen corporate earnings have been very, very good so far this year. We are in the middle of the second quarter earnings season, and so far, according to FactSet, 83% of the companies that have reported beat estimates. They've also raised guidance for the rest of the next quarter, slightly, and so corporates continue to make record profits, and that's also an indication of how strong the economy has been so far. And with all those 5 factors, those led to the impressive market recovery that we experienced when the markets pulled back in April after the so-called, Liberation Day, when the tariffs that Trump announced went into effect. We saw the markets pull back drastically, but so far since then, the markets have recovered everything that was mostly lost, and trading at all-time highs at this point. We've had 6 consecutive days of market highs over the last week and a half. So the recovery from the pullback has been strong, and that's primarily due to the fact that the actual underlying factors in the economy continue to be very, very strong. The fundamentals continue to be strong. Next slide, please. So as far as year-to-date sectors that have outperformed and those that have underperformed, we have industrials, information technology, and utilities leading the way. Those sectors have done really well so far year-to-date, whereas the underperforming sectors are healthcare, discretionary, and energy. So industrials have done really well, primarily due to the fact that that's the next iteration of this whole AI phenomenon. So there's a lot of infrastructure build out to support the AI trends. We also have reshoring, where a lot of factories are being built back in the US. A lot of economies are trying to diversify away from China based on due to what happened during COVID. And so there's been a trend of people bringing manufacturing back, to their own shores. And the US has been one major, market, for that trend. That also is also based on some of the trade negotiations that the Trump administration has had with a lot of companies to bring manufacturing back to the US. So industrials have been doing really well. Information technology continues to do really well based on the tech space continues to drive the markets. We have the AI phenomenon still in full swing, and we're still in the early innings of this whole trend. And so chip manufacturers have done really well. They continue to beat earnings estimates. The poster child has been NVIDIA, continues to exceed expectations. We also have in that space the software and application companies continue to do really well. And then we have cybersecurity that has also been one major driver of the tech space, and also robotics. So tech continues to be, a strong, space, and that has outperformed year to date so far. Utilities has also done really well year to date due to the fact that, the demand for energy and power generation is through the roof. Energy to support the AI phenomenon is not enough. And so utilities have, seen a lot of funds flow into that space to invest in generating more power. And we think that that trend is going to continue, long term. So those are the main factors that have driven these particular sectors to outperform year to date so far. Sectors that have underperformed include healthcare, which has been borne some of the brunt of the new administration's, policies. So Trump administration has, been putting in policies that are going to drive down some of the, drug prices, and also bring more regulation into the industry. We have a new Health and Human Services Secretary who has been an anti-vax for decades, and he's bringing a lot of policies to regulate the healthcare industry in the person of RFK, Robert Kennedy Jr. So the space has not done really well, partly due to the new administration's, policies, unfriendly policies. Consumer discretionary also underperformed because of the uncertainty in the markets. Well, as far as, the job situation, when, the new administration started cutting government, spending and laying off a lot of federal workers with the DOGE activities. And so there was a lot of uncertainty about the DC area and other sectors, other parts of the country that are reliant on government contracts and stuff like that. And so consumers, not being sure of their job situation, cut back on discretionary spending and focus on necessities and staples. And so that has led that space not to do well. One big subsector in the discretionary space is the housing market. Housing affordability has been a big drag on the market. And so house prices continues to go up, and that has affected how affordability level of most consumers. And so that has also been a drag on the consumer discretionary space. And then energy has been underperforming, and that's also been due to increase in supply versus demand. So the US has become energy independent and a net supplier of energy, whereas in the past the supplier has been limited by the cartel of OPEC. They don't have that power as much as they did in the past, and so supply has increased whereas demand has stayed stable. There was expectations of China coming back online after COVID. They're going to ramp up demand for energy, but that hasn't played out as well. And so with energy and oil prices staying around $70 for the last year or so, that hasn't boded well for the energy space. Next slide, please. So with all that being said, looking at what has transpired, year to date, and what we expect for the rest of the year, our outlook is encapsulated in these 5 points on the screen right now. And so we expect inflation, although it's come down drastically, we expect it to be sticky for a while before it goes down to the 2% target. We think that the last leg of the inflation trend towards the target is going to be the hardest part. And the main driver of inflation being sticky is the fact that the housing space continues to be difficult as far as prices coming down. We think that, we believe that it's going to be a while before home prices are going to come down, and shelter and home prices make up a third of CPI. And so until we see house prices actually coming down and also rents coming down, we think that inflation is going to remain, sticky for a while. However, we still think that the labor market is going to continue to be stable. We think that consumers are going to be comfortable with their job situations. We don't think we're going to see massive layoffs. And we also believe that there's actually more jobs coming online or into the country, into the economy the rest of the year, due to pledges made by a lot of large corporations to bring manufacturing and other jobs into the economy. So we think that the labor market is going to continue to stay strong. Typically, when unemployment creeps above 5%, that's when we see recessionary signs. But being around 4%, that's nowhere near recession. So we think that the labor market is going to continue to stay strong. We think that interest rates will likely stay high for longer, because to Gideon's earlier point, the Fed is in a wait and see approach just to see how this whole tariff uncertainty plays out with inflation. And so the Fed doesn't want to be boxed into a situation where they cut rates too soon and then inflation creeps back up and then they have to cut rates. They have to hike rates all over again. So we still expect that the Fed will likely cut rates, at least once, if not twice, before the end of the year. However, that's going to just bring the interest rates down to around 4% or 3.75. And so that's still higher than, a few years ago when interest rates were close to zero. So we think that even if the Fed cuts, rates are still going to remain, high, for longer before we see rates come down drastically. As far as, what's to look out for with, risk in the markets, we still think that the trade and tariff uncertainties is going to remain for a while, especially between the US and China. We've seen a number of trade deals being made over the last couple of weeks with different parts of the world. However, the ones with China is still ongoing. They had a meeting yesterday which ended without any major developments. And so we think that this is going to drag on for a while, and that could pose some risk in the markets, something to keep an eye on. And that is going to make volatility in the markets not go away anytime soon. However, we think that the big part of this trade uncertainty is kind of behind us, and the rest of the volatility is almost priced into the markets. And so we're not going to see a big drawdown like we saw back in April. However, we still think that we're not out of the woods, yet. And so something to keep an eye on is how these trade negotiations and tariff uncertainties play out. And so with all that being said, we still expect the economy to continue to grow. However, we think that the expectations for growth are going to be slower going forward. And so whereas, we were growing around 2%, we think that we're likely to remain sub 2% going forward, 1.5%, no more than 2% the rest of the year. However, that is no indication of a recessionary environment. The textbook definition of recession is to have 2 negative quarters of GDP growth. And so if we have 2 successive, GDP going in a negative direction for 2 successive quarters, that's when we have a recession. And at this point, we do not see that on the horizon anytime soon. Next slide, please. So with all that being said, where are we seeing investment opportunities? We still believe that there's a lot of opportunities in the US due to strong consumer position. Consumers, still have, good jobs, and as long as there's income coming in, they'll continue to spend, and that, provides opportunities to invest. The big, beautiful bill that was passed by the Trump administration went ahead to extend the tax cuts that were passed in 2017 when he was during his first term, and that also, makes consumers, feel wealthy because they have more discretionary funds to spend. So that also puts the consumers in a stronger position. We also see corporate earnings continue to be strong. Companies are seeing earnings continue to move up, and they're beating expectations, and that is making companies make long-term investing decisions much more easily. And so we think that that trend is going to continue to go on, and that also makes the US a favorite place to invest in. The other factor that makes the US attractive is reshoring, where they bring in manufacturing and factories back into the US, and that's going to create more jobs and makes investing in the US very attractive. However, like I said earlier on, one key component to keep an eye on is how the trade and tariff deals and negotiations play out. We've seen a lot of deals being made. However, we're still not out of the woods yet, and so we need to be aware of how things are playing out. So that's the US. There's a lot of opportunities outside of the US at this point. This year, so far, year to date, Developed International has actually outperformed the US. whereas, the major indices in the US are up around 9% year to date. Developed international, particularly developed Europe and also Japan, collectively are up, close to 19%. So one of the reasons why developed international has outperformed is for more than 10 years now, it's been underperforming. And so it's been, valuations have been depressed with, the US continuing to do well. Now, with everything going on with the trade, tariff impositions by the Trump administration, and also the demand for other countries to contribute as far as defense spending, there's been a lot of stimulus being passed in Europe, and a lot of European countries have increased their defense spending and bringing manufacturing also into their economies to support some of these stimulus spending, and that is creating opportunities. So we've seen a lot of capital move into these parts of the world, and that's been creating a lot of investment opportunities. So we've seen recovering economic growth in most parts of Europe this year. Like I said, stimulus spending and defense spending have all helped to support the economies. And with the evaluations from these parts of the world being very attractive due to years of underperformance, Developed International is one area to increase, exposure in this environment. And then moving on to emerging markets. Emerging markets continue to offer the youngest demographics around the world, very young population with a long, runway as far as demand for various services and products, comes into play. Valuations continue to be very, very compelling. And also we see a lot of reshoring in parts of the emerging markets with countries diversifying away from China. And so we've seen a lot of large corporations, building factories in India, which has been the biggest beneficiary of, getting away from China. We've also seen factories and industries being built in Mexico and Brazil. And so developed emerging markets continues to also offer a lot of investment opportunities in the current environment. Next slide, please, Albert. So with all that being said, we still continue to be overweight to industrials based on the factors that I mentioned earlier on. We still like utilities and infotech going forward the rest of the year. We will continue to be underweight to healthcare, discretionary, and staples. Discretionary and energy. Areas that we like that are neutral. We're not going to be overweight or underweight to, but mostly market neutral, include financials and also staples. But we want to be overweight to industrials, want to be overweight to utilities, want to be overweight to information tech, and take advantage of some of the trends that we currently see in the market. So this will bring me to the end of my prepared remarks, and I'll pass it back over to Albert as we prepare for Q&A. Thank you so much for your time.
Great. Thank you. Thank you so much, Peter, for that insightful presentation. I mean, so many solid insights from the three presentations have been shared. And I think just to summarize, as Peter mentioned, despite the volatility in the first half of the year, hinted in Gideon's presentation, markets have largely recovered. However, we are still not out of the woods yet. And so what this means is that it continues to be an active investors market, i.e., even though market is on the upward trend, it's not that for every segment of the market. And so it's important to have experts guide you to take advantage of those opportunities out there. And as Eric mentioned, the best minds, the most passionate and ethical professionals are at Access Wealth. And so we are always ready and prepared to help you build sustainable wealth. I mean, just a phone call or an email away, and we can get you started on that journey. And so thank you, Eric, thank you, Gideon and Peter, for the insightful presentations this morning. And so we'll zoom straight into the Q&A portion of the webinar. So gentlemen, I would kindly ask you to turn on your cameras for me, just so our audience would have you on their screens. Wonderful. Gideon, I see you. Wonderful, wonderful. Thank you, Peter. Thank you, Eric. Wonderful. Great. So once again, we'll encourage you to submit any question you have in the chat tab or box, and our webinars will address your question as much as possible. We have quite a number of questions in the submitted already, and so we'll do our very best to address them within the remaining time for the webinar. And so without wasting too much time, we can get started. Gideon, I'll come to you first. And we have a question on the exchange rates. It's a very major topical issue here in Ghana. And so, and especially with the service that we offer, executing wealth management services using offshore opportunities or investment opportunities. I think this is a major question. So the question is asking what is the forecast for the cedi? The forecast for the cedi exchange rate. I'm guessing they are referring to the cedi and the dollar. So what's the forecast for the cedi by end of 2025? Maybe you can share some thoughts on that.
Okay, thank you very much, Albert. So if you study the trend so far, we've had the cedi appreciate against the USD in excess of 40%. Since, I mean, the cedi stabilized around 10.3, gradually it's picking up again. Now, the latest data shows we are 10.48. Most consensus estimates forecast the cedi to close around the 12 Ghana cedi region. That would still mean that year on year, the cedi would have appreciated against the USD. But going forward, we expect some mild depreciation, but it should still lead to a yearly appreciation as we've seen so far. So that would be my answer.
Thank you very much, Gideon. Thank you very much. And so I'll move to Peter. Peter, we have a question in terms of asset classes. So the question, I'll read the question directly. Beyond sectors, which asset classes are you overweighting or underweighting for the rest of the year?
Thank you for that question, Albert. So as far as asset classes go, beyond the sectors, so we currently want to be overweight to large cap versus small cap. Small cap has underperformed year to date due to a lot of uncertainties in the markets and investment funds not really flowing into that space. So large cap companies usually have stronger balance sheets, and they're able to, weather difficult times better. So we're overweight to large cap versus small cap. We also increase our allocation to developed international, like I mentioned, whereas the past 3 years we've been way overweight to the US markets. That has slightly shifted, taking advantage of the trends that we see in Europe and other parts of the world. And so we've increased allocation to developed international versus the US. We still like the US, but not as much as we did a year or so ago. And then another area that we've increased allocation to will be emerging markets. And so there's actually, the broad emerging markets, which includes China, but then there's also emerging markets that excludes China. Our allocation to, emerging markets outside of China has increased. It still, kind of baffles me why China is still considered emerging markets. They are the second largest economy in the world. And most analysts believe that they should be outside of the emerging markets index and be put into developed markets. And so to gain exposure in the developing world, it makes sense to look for countries that are smaller than China that have a longer growth trajectory over the next few decades, like China experienced over the last few decades. And so those are some of the asset class changes that we're making to take advantage of the trends that we see, currently.
Wonderful, wonderful. Thank you, Peter. And so I'll come to you, Eric. Eric, you're up next. So we have a question from a participant, and he or she wants to. It's a point of clarification. So they want to understand if we discuss with our clients the market options or investment options available for them to decide, i.e., do they have a say in what we invest in on their behalf or not? So if you can share some light on that, Eric.
Because of course, the clients have, a lot of say in what we do for them. I initially mentioned that we have model portfolios, et cetera, et cetera. That's pretty much to take away all the heavy liftings of the client. So we do all the research, we do the back testing to ensure that, what we do for you 247 to ensure that you are getting the right return. So, but then you at times have clients who are also kind of a bit sophisticated and would want to have some input. So we listen to you. For instance, if you say you want probably an Apple stock in your portfolio, we sit with you and let you understand the upsides and the downsides and all that. So we listen to the clients extensively to ensure that we give you a fit for purpose portfolio. I know that a lot of clients, have dreams of having particular stocks and things in their portfolio. But then one thing we always tell people is that when it comes to investment, you take out your emotions. It's all about generating very good returns for yourself. So, so those are some of the things that we do. But we indeed engage the clients, we listen to them, and then we have extensive reports we share with them as well. All right.
Thank you, Eric. That's a key takeaway with investments. Take out the emotions, keep it on a level of balancing your returns with your risk. Thank you for that. As a follow-up to that, Eric, if you can stay with me. So there's a question asking what level of support or contact can clients expect from their dedicated wealth advisor?
So, well, for what we do, we also mentioned that we do a financial plan for you. So, and we also try as much as possible to meet you at least twice within a year. And also, but then within the year, you can reach out to us directly. So from financial advisory, if you have any financial conundrum you're dealing with, we are very happy to help you navigate around it. It's a much bigger team. So your assigned advisor, anything beyond them is always to rely on the other team member to be able to support you. So anything financial, anything with regards to your portfolio, or anything estate planning, we are more than willing. And as I indicated, we are very passionate about what we do. So be rest assured that you'll be well taken care of. Yeah.
Great. And then Eric, sorry, there are quite a number of questions for you. So I'll stay with you, and then after this, I'll give you a break. So there's a question on from a client in their mid-40s who is seeing retirement around the corner. And so the client is asking if undertaking or exploring offshore investments as part of their wider investment portfolio is a good area, or is a viable option for them, seeing that retirement is around the corner.
Yeah, for me, I would say it's a big yes. Diversification is important. Having access to more matured markets, which are highly liquid, which has some of the best practices you can think about. You hardly hear of anything DDEP in global markets and things like that. So it's important to have. A couple of years back, the main issue would have been access to those markets in a very smooth way. And that's what Access Wealth is here to provide, give you that access and to ensure that your portfolio is solid. You've hedged against currency, because of course you are in another currency. By mid-40, I'm certain that, I mean, you've got your tier twos, your pensions, everything it's in Ghana cedi, right? So it's important that you also have a bit of your retirement nest egg in a different currency of some sort. So by the time you get to retirement, you have a much solid, balance or wealth, if I should say that. So it's a very, very important thing, and it's actually highly recommendable that you'd consider doing such a thing for yourself. Yeah.
Wonderful, wonderful. Thank you so much. Thank you so much, Eric. I'll give you a few minutes to grab a glass of water, and then we'll come back to you with some additional questions. And so, Peter, if you could address some questions for me. So, the first one, and I'll read one, and then when you address it, I'll read the other. So the first question is trying to inquire how we are positioning portfolios to take advantage of the opportunities that we see going forward in the second half of the year.
So as far as positioning of our portfolios, like I said earlier on, we have reduced our exposure to the US market based on valuations primarily, and also the dollar was, trading at all-time highs and started, underperforming versus other currencies. We saw a lot of opportunities in developed international, and so we increased our exposure there. We also saw opportunities in emerging markets, ex-China. And so that also, we saw some opportunities over there. As far as domestic US markets go, with the volatility that we saw beginning of the year, a lot of the high flyers obviously had been trading at all-time highs. Most of the returns in the last couple of years was, generated by the Mark 7. And then, so this year we saw only 5 of those Mark 7 actually continuing to move higher, whereas 2 were, not doing well. Those were Tesla and Apple. But we saw a kind of a fatigue in the tech space, and we saw opportunities in utilities. And so we did increase our allocation to utilities and the value space in general versus growth. And so those are some of the portfolio changes that we've made to take advantage of market trends. But with all that being said, the overall market themes that we like that continue to power our portfolios include the whole AI phenomenon. We think that we're still in the early innings, but we're not going to be allocated or just put everything into chip manufacturers. We're trying to be diversified within the space, and so the actual chip manufacturers is one aspect of it. We have the equipment manufacturers that supply these chip manufacturers as also one play in the AI space. We have the software companies that actually make the AI theme actually play out with with individual users. That's also one space, and those are all one iteration of the AI phenomenon. And now we see a lot of opportunities in the infrastructure build out for AI. So data centers that are being built, and then the energy demand that is going to support these data centers. So there's 3 broad themes within the AI space itself that continue to be very attractive. We think that we're still in the early innings of that whole phenomenon, and that's going to play out for decades to come. So those are the major themes that are driving our portfolios at this well. But we're trying to be diversified and not put everything in NVIDIA or Broadcom or ASML. We try to be diversified across that space.
Great. Diversification, they say, is the only free lunch. And so
yes,
yes, it's good that we apply that. Peter, as a follow-up to that, so I think so we have a question on the sectors, and the question is, in which capacity would we be invested in utilities? since energy, a sector we are moving away from, tends to be recognized as a utility. I think the participant is looking for clarification between utilities and energies, which I think utilities we are overweight, but with energy we are underweight. So just to clarify the differences there.
So broadly, when we say energy, we're referring to like oil and gas. And so energy prices referring to what we pull in our, so petrol, price in our local parlance, what we use to heat, our homes, for instance, and that's energy. But then when we're talking about utilities, we're talking about electricity. We're talking about clean energy. We're talking about, the grid, power generation. And then we're talking about alternative sources of, power generation. So when we talk about AI, just even on our phones, when you do one quick search using ChatGPT or Perplexity, it takes seconds for the results to come back. And that's because those AI tools use thousands more energy than our ordinary Google search. And if, the adoption for AI and this new technology continues to increase, it's going to demand a lot of power generation to make it happen. And that's where we see the opportunities are. So there's actually a trend of investing in nuclear energy, because that's the only cheap way to be able to support the energy demand that's going to come from AI growth. So that's the distinction between utilities, we're talking about like electricity generation or power generation versus energy, which is that refers to fuel, for our cars and fuel for our homes and stuff like that. So I hope that answers the question.
Very much so, Peter. Very much so. Thank you so much for that. And I think if you can take one last question for me, and I'll move on to Gideon. So Gideon, kindly get ready for me. But Peter, so there's a question on risks. So the question is, are there any specific risks investors should be mindful of in the coming months, at least from a global perspective?
So there's always going to be risk in the markets. Investing comes with risk, and that's the more reason why you usually experience a higher return for a higher risk undertaking. But as far as in the immediate to short term, I will say the biggest risk in the market is the trade and tariff uncertainties that continues to play out. It's still a risk because it's hard to quantify how things are going to play out. It's hard to predict how it's going to happen. It all depends on, one person's thoughts and feelings about how the negotiations are going. So basically, if Trump says, we had a deal with X country and it's a done deal, then it's good. But what are the metrics for determining what is a good deal or what is a bad deal? Nobody knows except for, the administration. And so that continues to be a wild card, if I can put it that way. There is a term that was coined over the last couple of months in the US, where they referred to, Trump policies being, TACO, TACO, meaning Trump always chickens out. And so the markets, were beginning to kind of suggest that Trump always will stake out an extreme position, and then eventually he will back off and he will give into like a baseline a deal. And so the markets have started to ignore some of these extreme positions that Trump takes, and so they coined the term "tackle Trump always chickens out." And that's why even when deals were announced recently, we didn't see major moves in the markets. So whether the deals go through or not, the markets have kind of priced most of it into, their metrics for the time being. And like I said, we're still not out of the woods yet, because it looks like the biggest, deal that is yet to be made is the one with China. And as to how that is going to play out, nobody knows. And so I would say in the immediate term, that continues to be, the biggest uncertainty, because it's hard to plan around that. It all depends on, how Trump feels, basically. But otherwise, the other risks, continue to be out there on the markets. Geopolitical tensions continue to, rage around us. That's not going to go anytime soon. Inflation is continuing to be stable unless we see like a huge spike in inflation. We don't think that that is going to be a major risk in this environment. And so I would say the biggest thing to look out for is how the trade negotiations, play out in this environment.
Thank you. Thank you very much. Thank you very much, Peter. So we'll keep an eye on Trump, keep an eye on China, and we'll continue to look at the sectors that offer the best opportunities, again, to reward the risks that are associated with the investments that we are undertaking. Thank you. Thank you for that. So I'm coming back to you, Gideon, if you are ready for me. So the first question is, how do emerging market securities compare in terms of attractiveness to developed markets, and in the context of the current global climate?
Okay, thank you, Albert. So whenever you are doing comparison between emerging markets and developed markets, the baseline for comparison is the risk that the investor is taking. And risk is also priced into securities or asset prices. So definitely, in terms of prospective returns, investing in the emerging markets is likely to give much more higher returns because we are pricing in a higher risk environment than the developed world. But I mean, if you want to also put risk aside, then, or you don't want to take that much risk, then you just look at, I mean, investing in a safe haven environment, which would also come with commensurate returns because you are not taking that high risk. So that's, I mean, how securities in emerging markets and developed markets compare.
Thank you, Gideon. And then a follow-up to that, again, exploring different kinds of assets or investments. How advisable is it to invest in treasuries, or I guess, yeah, so specifically treasuries in this current economic environment?
Okay, so investing in treasuries basically signifies that the investor is not willing to take up risk, additional risk, in addition to what the exposure to government is. So in an environment where markets have been volatile, especially when there are tariff uncertainties and its impact on markets, someone who doesn't want to take up that risk definitely would invest in treasuries. If you have an aggressive investor who is willing to take up the risk and make more returns, that person might also venture into the volatile markets where he's expected to get commensurate higher returns. And so it boils down to the baseline, which is the risk profile of the investor. In times when people feel that the risk is just too much, we often hear this term safe haven investments. Most investors would move into gold or treasuries. And so it's the risk profile of the investor. If you feel risk is just too much for you to bear, safe haven investments, gold, treasuries are the options.
Thank you so much. Thank you so much, Gideon. And so I think we can take our final round of questions and then call it a day. So let me go to Peter. Peter, I have a question here which is quite interesting. It actually comes up during a number of client engagement. So the participant wants to know, what are the investment prospects offered by digital currencies? So the whole works when it comes to these digital currencies. Are they viable options for investors to consider as part of their portfolio?
Sure. Yes. Thank you for that question. So digital currency, like I've said, in past events, it's hard to value them basically. You invest in an asset class based on the cash flow that you expect from that asset. Okay. Now, if you're investing in currency, there is no cash flow from that asset class. What you're basically investing in is a store of value or speculation that is going to move up, but there's no cash flow coming from that particular investment to be able to use it to value it. So I don't have a problem with investing in currency, but that's similar to buying dollars and keeping it under your bed expecting that the value is going to go up. It's no different. Okay, so it's something that is basically a preference of the client. Obviously we don't have any problem with that. However, if you are trying to value, what to expect, from such an asset class, that's an almost an impossible task. It could go up and down based on sentiment. It could go up and down just based on demand and supply, but not necessarily, due to investment, purposes or investment metrics. And so that's what I would say to that. There's no, nothing against investing in digital currency, but you cannot value it how you value asset classes, other asset classes basically. So that'll be my response to that question.
Thank you so much, Peter. Like I said, it comes up quite a lot, so this insight is quite helpful. So there's a hand raised, so I'll interrupt our last round of questions just to give this participant an opportunity to ask his question, and then we can resume the final rounds of questions. So Charles, if you can hear me, please kindly unmute and ask your question. Hello, Charles.
Hello, can you hear me?
Yes, we can hear you. Wonderful. Good morning. Please, you can go ahead and ask your question.
Oh, I don't have any questions. I'm not sure.
Oh, okay. Your hand was raised, that's why.
Oh, sorry. Probably a mistake. Sorry.
Okay. Thank you. So I think we can go back to, so Gideon, I'll come to you with the last question, and it has to do with investment strategy, and tips. So the participant wants to know if you can share any investment strategies or tips for navigating market volatility and achieving long-term investment success.
Okay, thank you, Albert. So outside portfolio management, where we have some strategies that we employ to manage risk, I think for a client, we have to go the non-portfolio management route, which is to stay calm, don't panic when markets are volatile. Most often when markets become volatile, people forget about their long-term investment objectives or investment goals overall. And may take certain decisions that may not go well in the long term. So clients should always remain calm stick to their long-term investment objectives, and also seek advice from professionals before taking any action on their portfolios. So that'll be it from me, yes.
Thank you. Thank you so much, Gideon. And Peter, please, I know I promised that was the last question, but this an interesting one just came. So kindly allow me to pose this question to you. So the question, I'm going to read it directly. There's been some view that the US equity market is overvalued. What is your outlook on the broad market index in the US? And do you think there's still room for appreciation?
So I will agree to I'll agree partly to that premise that yes, the market is overvalued, but it's not every part of the market that has participated in the strong uptrend. And that is why we say that this is an active investors market. Active management comes in very handy. This is not a rising tide lifting all boats. There's pockets of the market that are very undervalued, very overvalued, and there's pockets that are very, very undervalued. And that's one of the reasons why this year so far we've seen the value space outperforming the growth space for the most part, and also small cap continues to underperform, but the large cap space, that's where we saw a lot of the pullback, because over the last 2 years or so since the pandemic, that space has done really well. So I would say it's company specific and sector specific, but there's still areas where there's a lot of undervaluation where you can definitely get some good investment returns in the US market. But if you talk about the broad US markets, yes, the broad markets are overvalued compared to other parts of the world, like developed international, where it's been underperforming for over a decade, and so the valuations are more attractive. But even there, you have to be careful where you invest in, because there's you don't want to be caught in what we call value trap, where a sector or a company is undervalued, but it could be undervalued for a reason, and it could continue to go down even though it's undervalued. And so all comes back to being active as far as looking for investment opportunities. Okay.
Wonderful. Wonderful. Thank you so much, Peter. There's a related question on the US market trading at 22x earnings, and so I think that has also been addressed. So let me go to Eric, last but not the least. If you can take the last question for me, which it's a number of questions, but I'll just marry them and pose them as one. So participants want to know how they can take advantage of the offshore opportunities. What is the onboarding process, and is there a minimum investment amount required to be able to participate?
Yeah, I mean, once you just reach out to us, I mean, I mentioned a couple of years ago, doing offshore would have been very difficult, but we make the process very painless. I wouldn't want to spend time outlining the entire process, but we'll set up a meeting and have 1 or 2 calls, and that should be fine. We can easily onboard you onto the platform. There's a lot of heavy lifting that is done on our side. So normally we say that the threshold should be around $25,000, or you should be willing to build your portfolio up to $25,000 within a 24 to 48 month period. So those would be the things, but I mean, for starters, you would have to establish some contact, either through emails, calls, and then we set the ball rolling. We do all the heavy lifting on our side, and you definitely get you access to this market. Yeah.
Sure. Thank you so much. Eric. And just to add to that, once the webinar is over, a window would open with a form in the survey just to rate your experience. And you can also share your contact details there, and our advisors will reach out to you to engage further if if this is something that you want to explore, the viability for you. So kindly be on the lookout for that window, and drop your contact details there. And so all too soon we've come to the end of the webinar. Thank you, Gideon. Thank you, Eric. Thank you, Peter, for leading us in the discussion. And thank you to all of the participants for joining us today. We hope you enjoyed the discussion and found the insights valuable. We encourage you to speak with our advisors, as I mentioned, to discuss your specific needs, and how you can take advantage of this wonderful offering, and be assured that you'd be met with passionate professionals that are, as Eric said, that are willing to help you get started. And so a form will appear once you exit the webinar, again, to rate your experience, and also for you to leave your contact details with us, just so our advisors can reach you via your preferred medium, whether email or phone, to discuss your specific needs. And so at this point, once again, I want to say thank you for giving us a bit of your morning today, and we look forward to hosting you in future events organized by Access Wealth. And so at this point, say goodbye and do have a wonderful day.
Thank you, everybody. Thank you.